Right now, in a city most Western investors couldn't find on a map, someone is paying $96.98 for a single ounce of silver. Pull up any trading terminal in New York or London, and the screen says 88. That is a $9 gap. That is not a rounding error. That is a distress signal from the physical market. And almost nobody in the West is listening. The price comes from Shenzhen, from a dealer called RT Gold, and it represents what a real buyer with real money is willing to hand over for metal they can hold. Not a futures contract, not a paper claim. Actual silver, weighed, verified, and walked out the door. When physical buyers pay 10% above the globally quoted price, they are telling you something the charts cannot. They are telling you the quoted price is a fiction. But the premium alone isn't the story. The story is what's happening inside the vaults. Shanghai Futures Exchange silver stockpiles have collapsed to roughly 353 tons. That is the lowest reading in a decade. Not a seasonal dip, not a temporary drawdown. 10 years of warehouse data, and the needle is sitting at the floor. Meanwhile, the Shanghai Gold Exchange reportedly hemorrhaged 43 tons in a single week. 43 tons, gone in 7 days, with little to no replacement metal arriving to fill the gap. So you have inventories at generational lows, drawdown rates that are accelerating, and physical buyers paying almost a double-digit premium over the paper price. These 3 data points, taken together, describe one thing: a market where the paper price and physical reality are splitting apart. And when that fracture reaches a critical width, the reconciliation is never gentle. This is the anatomy of a squeeze that is already underway. Not a theoretical one, not a predicted one. One that is showing up in vault reports, dealer quotes, and industrial purchasing behavior right now. And the timing could not be more consequential, because Shanghai's exchanges have just reopened after the Lunar New Year holiday, and every trader returning to their desk is about to see exactly what happened while they were away. To understand why this moment matters more than any inventory report in the last decade, you need to understand the machinery underneath it. How silver actually moves between vaults, futures exchanges, and factory floors. That machinery is breaking, and here is where it started. Silver has always lived a double life. To investors, it is a precious metal, a store of value, a hedge, a speculation. To industry, it is an irreplaceable input. Every solar panel depends on silver's electrical conductivity to convert sunlight into power. Every data center expanding to meet the explosion in artificial intelligence requires server components that use silver for thermal management and electrical connections. This dual identity is the tension at the center of everything happening right now. The Shanghai Futures Exchange, the SHFE, operates as one of the world's major commodity platforms. Silver held in its registered warehouses represents deliverable inventory, metal that can be called upon when a futures contract matures and the holder says, "I want the physical." When that stockpile shrinks, it means metal is leaving the system, consumed by factories, moved into private vaults, or exported to regions where the price commands a higher premium. At 353 tons, the SHFE is operating with a thinner cushion than at any point since the mid-2010s. The Shanghai Gold Exchange tells a parallel story. 43 tons exiting in 1 week is not a slow leak. That is a structural drain, and it reflects a reality that pure price charts never capture. Industrial users are not passive participants. A solar panel manufacturer in Guangdong with production orders to fill does not watch the price and wait for a dip. They secure metal because the alternative is halting a production line, missing delivery windows, and losing customers. The cost of not having silver is greater than the cost of overpaying for it. And right now, the world's largest solar panel manufacturing base is competing for a shrinking pool. If you are finding this kind of structural analysis valuable, the sort of breakdown that goes beneath the headline number, hit subscribe and like. Because the next layer of the story is where the entire framework of how silver is priced starts to come apart. Layer that industrial appetite on top of the AI hardware build-out, a source of silver demand that barely existed 2 years ago, and you have a consumption profile that is growing in directions the market's supply infrastructure was never designed to handle. Silver mine output has been roughly flat for years. Recycling fills part of the gap, but cannot respond quickly to sudden demand surges. The math is simple and unforgiving. When consumption accelerates and supply doesn't, the buffer is inventory, and the inventory is vanishing. This is the foundation. Industrial demand that cannot be switched off. Inventories at decade lows, a drawdown pace that is picking up speed. Under normal conditions, this imbalance would already be reflected in a rising price. But silver does not trade under normal conditions. It trades across 2 very different markets, and that is where the real distortion lives. Here's the fracture most investors never see. On the COMEX and the LBMA, silver trades in enormous volumes every day. Contracts are opened, closed, rolled, and settled, often without a single ounce of metal changing hands. These platforms trade claims, obligations, and paper positions that reference silver but do not require its physical movement. The system functions smoothly as long as most participants never ask for the actual metal. It is, in essence, a confidence game running on the assumption that delivery requests will remain a small fraction of open interest. In Shenzhen, the market operates on a fundamentally different principle. RT Gold's buyback price of $96.98 is not a theoretical mark. It is the price at which real metal is moving between real hands. No netting, no rolling, no cash settlement. When those two systems, paper and physical, begin quoting different realities, it is not a glitch. It is evidence that the paper architecture is losing its anchor to the commodity it claims to represent. The gap is currently near $9 per ounce, or roughly 10%. That is not normal. In a well-functioning market, arbitrage would close that spread quickly. Buy where it is cheap, sell where it is expensive, pocket the difference. But arbitrage requires available supply on the cheap side. On the cheap side, the paper market, cannot deliver sufficient physical metal to satisfy the expensive side. The gap doesn't close, it widens. And the participants who understand this most acutely are the producers themselves. Major silver miners have been reported selling directly to physical buyers at premiums of 26% above COMEX, bypassing the futures market entirely. When the companies pulling silver out of the ground choose to avoid the paper exchange, that tells you everything about where they believe true price discovery is happening. Now factor in the calendar. Shanghai's exchanges were closed for Lunar New Year through late February. During that shutdown, physical dealing continued, generating the premium data we see from Shenzhen. But futures trading was paused. The moment those exchanges reopened, returning traders confronted a reality that accumulated during their absence. Wider premiums, thinner inventories, and a Western paper market that spent the holiday pretending none of it was happening. That reopening injects fresh liquidity, fresh positioning, and fresh panic into a market that was already structurally tight. The broader environment only adds fuel. Trade policy uncertainty between Washington and Beijing. The U.S. Supreme Court striking down reciprocal tariffs, followed immediately by threats of new ones. U.S.-Iran negotiations carrying the ever-present risk of escalation. Each of these, independently, supports precious metals as a haven. Together, they form a macro backdrop that gives the physical squeeze a tailwind it would not have had in calmer times. This is no longer a story about an inventory report. This is a collision between a paper system designed to manage price and a physical market that is running out of the commodity the paper claims to represent. Let's follow the logic to its conclusion, because the arithmetic is unforgiving. Every ton that leaves the Shanghai Gold Exchange has one of three destinations. It enters a factory and gets transformed into solar cells, circuit boards, or industrial components, in which case it is consumed permanently and will never return to the precious metals market. It moves into private storage, sovereign vaults, family offices, high net worth individuals pulling metal out of the exchange system and into allocated accounts they control directly. Or it travels through physical arbitrage channels, to wherever the premium is highest, draining one region's supply to fill another's desperation. In every scenario, deliverable inventory shrinks. The pool of silver available to satisfy futures contracts, to backstop paper positions, to balance the ledger between what is promised and what exists, the pool is getting smaller. And fresh mine supply is not arriving fast enough to reverse the trend. Silver mining output has stagnated. The largest deposits are aging. New projects take years to permit and develop. Recycling helps at the margins, but cannot scale on a timeline measured in weeks. So the question becomes mathematical. If 43 tons can leave Shanghai's vaults in a single week, and replacement supply is negligible, how many weeks until the system faces a delivery crisis? You do not need a conspiracy theory. You need a calculator. Here's the question worth sitting with. If physical silver is already pricing near $97 in the world's largest manufacturing economy, and the paper market still says 88, which number do you trust to describe what silver is actually worth? Drop your answer in the comments, because that question is the entire thesis of this video compressed into a single choice. The paper market has tools to manage stress. COMEX can raise margin requirements, making it more expensive to hold positions. Exchanges can impose position limits or force cash settlement instead of physical delivery. These mechanisms exist precisely because the system's architects understood that unlimited delivery demand would break it. But each time those levers are pulled, they reinforce the message the physical market is already sending. The paper price is administered, not discovered. Technical levels crystallize the stakes. Silver is holding in the $86 to $88 range, above its key moving averages, which keeps the bullish structure intact. The $92 level has emerged as a critical threshold. Multiple analyses point to it as the gateway. Above 92, the path toward 100 opens with minimal overhead resistance. Beyond that, the all-time high around 121 becomes the gravitational target. On the downside, 85 has proven to be near-term support, with the 50-day moving average near 80 providing a deeper floor. But these are paper levels. The physical market is already trading well above them. The resolution of this divergence follows a historical pattern that is remarkably consistent. Paper markets can suppress, delay, and distort price signals, but they cannot manufacture metal. And when the gap between what is promised on paper and what exists in reality grows wide enough, the snapback is sudden, violent, and irreversible. Let me be direct about what could derail this thesis, because intellectual honesty is worth more than false certainty. If a significant holder liquidates inventory, premiums can compress overnight. If industrial demand cools, a slowdown in solar installations, a pause in data center construction. The consumption pressure eases. Chinese regulators have intervened in commodity markets before, and they will do it again if they decide premiums are destabilizing. A dramatic de-escalation in geopolitics or a surging dollar could pull the macro tailwind away from precious metals entirely. These are real risks, and they deserve real weight. Markets are not one-directional, and the history of squeeze narratives includes chapters that ended in sharp reversals. But here is how the evidence stacks up against those risks. The inventory data is not ambiguous. 353 tons at the SHFE is a factual floor, not an estimate. The premium in Shenzhen is a transactional price, not a survey. The industrial demand is structural. Solar capacity is expanding because governments are mandating it. AI infrastructure is expanding because the technology demands it. And neither of those trajectories reverses because silver becomes more expensive. Factories do not stop producing because an input costs more. They pay the premium and pass the cost forward. That behavioral reality is the engine driving this entire dynamic. So here's the framework. Watch the Shanghai data over the coming days. Whether inventories stabilize or the drawdown continues. Watch the physical premiums. If Shenzhen buyers keep paying mid-90s or higher, the squeeze is intensifying. Watch silver's performance relative to gold, because in a genuine supply crunch, silver's smaller market amplifies the effect. And watch how the paper exchanges respond, whether they tighten margin requirements or adjust delivery rules. Those administrative moves are not neutral, they are confessions. Think back to where we started. A $9 gap between what a screen says silver costs and what a buyer in Shenzhen actually pays for it. That gap is not a quirk. It is a fault line running through the architecture of how the world's most industrially critical precious metal is priced. On one side, a paper system built to manage orderly trading. On the other, a physical market where real scarcity is forcing real price discovery. For years, the paper side has set the terms. The vault data suggests those terms are expiring. Two realities cannot coexist indefinitely. Either fresh supply materializes in sufficient quantity to close the gap from the physical side, or the paper price rises to acknowledge what warehouses in Shanghai and dealers in Shenzhen already know. One of those outcomes requires a geological miracle. The other requires only that arithmetic catches up with inventory. The vaults are draining. The factories are consuming. The premiums are widening. And somewhere between the number on your screen and the price being paid on a trading floor in southern China lies the true value of silver, waiting for the rest of the world to catch up. The only question left is whether you see it before the price does.